Hello, everyone. Welcome to Andromeda's Credit Macro Webcast, presenting the team's outlook and the opportunities they see over the next few months. We have Alberto Gallo, co-founder and CIO, Aditya Ani, co-founder and PM, and Tao Pan, our head of research. We are really glad to have you join us today. We'll have time for Q&A at the end of the call, so please feel free to add questions to the chat as we go. And with that, Alberto, I'll hand over to you.
Thanks, everyone, for your time. So over the next 20 minutes, we're going to explain our views and outlook for markets and the differences that we see between this year and next year in the credit cycle, and also, how we're positioning, how we want to capture the opportunities over the coming months. After a year where the consensus was generally at the beginning of the year to be long bonds, long duration, to position for a recession, we've held a relatively different view. And after a year where this consensus essentially turned out to be wrong, we now have a higher for longer environment that markets are finally, taking in, and investors are finally realizing. What does this mean? Well, it means that probably, we're not going to go back to a very low interest rate environment. The question that we asked investors over the past few months is, do you think we're going back to the pre-COVID world, or are we in a different world? And, we are starting to all realize that we are in a different world. What we need to understand is what the opportunities are and how we invest, how we trade in this environment. So we continue to think that higher for longer is here to stay, and it's not completely priced in, both in stocks and in credit markets. And in the rates market, only recently we've started to see the long end of curves moving higher. The missing piece to the normalization puzzle is quantitative tightening. We had a lot of hikes in the short end of curves from central banks to new highs. We had the long end moving to new highs, but we haven't had a lot of balance sheet normalization by central banks. So this is still in the cards, and it's still not completely priced in. Inflation is sticky. We just had the CPI numbers for the US, which have shown that core inflation, is higher than expected. And we continue to see a sticky core, as you can see from wage negotiations globally, and especially in the US and the UK. On top of that, we'll have a consistent, continued environment of high fiscal spending, where governments will continue to spend given the necessity for keeping the electorate relatively happy into elections next year in the US and the UK, and given higher geopolitical risks that were already present and now unfortunately increased after the events over the last few days. So in this context, government bonds are not attractive, and credit is pretty attractive still, and particularly in selective areas where we like to go. It is not an environment where you want to be, levered long, because there's going to be volatility. There's going to be things that break, and we have seen it with Credit Suisse and SVB. We might see something breaking again, but it's an environment where from time to time there are swings, there are waves of volatility, and we're very excited to be able to capture them. So the first point is, that I want to make is higher for longer. What does it mean? Well, it means not just that the short-term rate has gotten to a level close to where it should be, in our view, even a little bit higher, but the long-end rate, the 10-year, has gotten to around 5%. Now it's a little bit lower, but we do think that the fair value for Treasury 10-year is 5%, and it's around 3% for bonds. In this context, though, there are in the world a lot of capital structures, both corporates and sovereigns, that have been refinancing at 2% or 3%, or might no longer be sustainable. So our job here is essentially to, invest your capital and understand which companies and sovereigns are the ones that can pass on high inflation and high rates to customers, which ones are the bad, the ones that we'll have to restructure, which we avoid, and which ones are the ugly. And the ugly are the ones that have to sell assets, that can get government support or external support, and eventually are able to survive. So we think this is a breaking of a long time trend, and it's here to stay. And our fair value for the 10-year continues to be around 5% or even higher. We don't think that these are levels where you want to pile into duration. We don't think that the bond sell-off is over. We think the recent discussion from the Fed on long end yields is being done to calm markets down in a way to make sure that the Treasury can fund. And obviously there is a dynamic between the Treasury Secretary and the Fed there. And the speed of the move is something that the Fed really cares about, but the level is something that eventually will depend on supply, on spending, and also on productivity gains and higher R star, which is not going to be, it's going to be higher than before. It's not going to be 2%. We think it's going to be closer to 3% in the US. Now, the question you might ask me is, the Fed hiked 500 basis points and nothing really happened to, why is that not enough? Nothing really happened in risk assets. Yes, there was some volatility around regional banks. We had SVB, but eventually, we had a much more muted reaction in the market and in inflation than we would have had. Than we would have thought. And the reason is that the tightening of short-end rates only affects really half of the economy, and that's the bottom half, the poorer half, unfortunately. It's the people that fund with auto loans, with credit cards, but it's not the large firms, it's the small businesses. And so when you have a long end rate that's still at 3.5% or 4%, and the front end is above 5%, the largest companies like Microsoft's, the Apples, can essentially run a carry trade. They can fund with a 4% rate, they can invest their cash at 5.5%. So the real tightening for the top 50% of the economy, which is the first two quartiles of wealth, is really happening right now. It's really happening with the long end moving wider. And that's really what's going to affect, the indices in the market, the S&P, as well as the high yield indices, which reflect, larger companies, especially if we are talking about, the liquid high yield market. So we're starting to see this. It's not just about variable lags, long and variable lags for the tightening in front end rates, but it's also the delay in the long end yields going up. They've just started to go up now, and then there will be a lag from that. Having said that, we could also make the point that we like the Treasury 5%, and we've never had that yield before, and some investors have been waiting for a long time. But we think that higher for longer is here to stay, and that's why we haven't been adding duration here. We think that there's still more widening to come, and one of the reasons is that there's a repricing of labor globally. Post-pandemic, the demographics have changed. There's been a lot of early retirements. The workforce participation has gone up. The workforce is stretched to its limits. In the US, there's the highest number of women coming back to the workforce, which is good, but there's also lack of extra marginal workers. That will keep, in our view, negotiations tensions across negotiations between workers and employers. And this repricing is global. We're also seeing it outside of the US, and it's typical of what happens post-pandemics. Another factor why we think inflation is sticky is geopolitical risk. We have a rupture in the US-driven peace that we had for many decades, and the commodity-rich countries are now against the Western Bloc, and we've seen this in various hotspots in Ukraine and now in the Middle East. As a result, we do think that fiscal spending will continue. We do think that long-end rates and long-end supply will continue to be elevated. Another reason why inflation and long-end inflation expectations might continue to stay high is that we've been for a long time in a high inflation environment. And as the Bank for International Settlements shows, inflation is self-reinforcing. And if sustained for a certain period of time, for over 6 to 9 months, it can become a price-setting device for all goods. In other words, Many businesses that normally would set different prices for their goods or services start setting prices together following the same inflation number because they are essentially getting used to a higher inflation regime. So that number becomes the indicator, the driver of price setting for a number of industries, and inflation becomes more homogeneous. So that's a risk that we've definitely seen happening, taking place in the UK, potentially also in the US. So it's easy to go back from a high inflation environment to a low single-digit inflation environment, but it's going to be very hard to go back to target. And so what we see is that for year-end 2023, we're going to be at 3.6 for headline and 3.5 for core in the US. And in the Eurozone, we're going to be at 3.4 for headline and 4.0 for core, according to our models, which are run by Tao Pan. She will go in more detail later. And for the end of next year, we'll be around 2.5 in the US for both core and headline, and around 2.4 in the Eurozone. However, there is risk to the upside, especially if commodity prices continue to stay high. And if we have $100 oil or higher oil, then we'll have a risk of being with a 3 handle on inflation into the end of next year. Despite the increase in interest rates, as we discussed previously, we haven't really seen a cheapening in the cost of labor. In fact, workforce participation is going up, but it's also reaching a limit. And average hourly earnings have fallen to a more normal level of growth. However, we continue to see scarcity of labor. We continue to see a relatively high job workers gap. And as we see on the chart on the left, the relationship between average hourly earnings and the jobs labor ratio has normalized to what was historically the relationship. So we're not seeing anymore the average hourly earnings outperforming job labor ratio, growing faster than the job labor ratio would suggest. But the job labor ratio is still there, and wage negotiations still suggest that services will be sticky in the future. So in this higher for longer context of sticky inflation, high central bank rates, no recession, but also no cuts, and slowly rising default rates because capital structures are not sustainable, with central bankers, slowly trying to manipulate the shift from low rates to high rates. How are we supposed to invest? Well, there's a lot of differences between different regions, and there's going to be a lot of differences between different companies, which we haven't seen yet. I would say the biggest observation is that the US continues to outperform the Eurozone, both because of stronger fiscal capacity and because of production of commodities, so not being hurt by high commodity prices. So the US Eurozone growth gap is still very wide and probably will continue to widen. Unfortunately, the conflicts in Ukraine and in Israel don't play positive for Europe, so they're negatives for Europe, and high commodity prices and geopolitical risks are negative for Europe. We have seen in the past year, in the past years, a lot of spending in Europe, the Eurozone Recovery Fund, which was unexpected and unusual, but we don't see Europe being able to continue at this clip of fiscal deficits. There's one word that you haven't heard of in the last few months, and that's austerity. Eventually, austerity will have to come back in the Eurozone. So we see the US continuing to outperform, and the Eurozone in a technical, very mild recession in the end of this year, beginning of next year. A special case is the UK, where we have stagflation. So we have a really poor growth inflation mix. There's been a lot of cyclical spending in the UK during the pandemic to support incomes. This means that the budget needs to be tightened now. There's more shortages of labor. There's constraints to the supply of labor in addition to the ones that we normally would have. So because of immigration controls. And this has resulted in a stagflationary environment. Moving to China. China has been the only place where central banks, their policy has been dovish. There's a chronic balance sheet recession, and stimulus has been discussed, but it's not been the same stimulus as before. It's not been a large fiscal stimulus. It's mostly monetary. We know that monetary stimulus without the fiscal gunpowder doesn't really work. So China we see as a stable situation, but without a silver bullet that can solve the problem. So we don't see a strong impulse from China. And finally, the elephant in the room is Japan, where the BOJ is something that has really been key in our view to keeping the long end of yields tight, and as a result, spreads tight in the past. We do see more weakness. The BOJ has been essentially pretending that inflation is not sustainable and they can't hike yet, but eventually they will. And that's one of the biggest risks that we see to volatility, to financial stability here. So we are definitely not in a Goldilocks environment. This year we've been we've been quite complacent in the market. And at points in time, like Credit Suisse, for example, and SVB, and during the widening that we've seen in the last few days on the long end, we had periods of volatility. But if you think about the shift that we are seeing in the market from a very low yield environment that was here for really 20 years, from the QE era to a higher for longer environment, we have not seen much breaking yet, and probably there's going to be more things that break in the future. In this context, again, the surprise is that we've had central banks. The good news is we've had central banks that have been really good at maintaining financial stability. They've learned their lessons from 2018, so they have managed to raise rates in a relatively orderly way. However, the real hard part, which is moving the long end up, which is how most firms really fund themselves and mortgage borrowers, well, that's still to come. And it will have to come at some point later in the year or next year, including with the BOJ that will have to exit yield control and move from negative rates in the front end as well. In this context, credit has been an interesting asset class. It's more interesting at times where there is instability, so that's where we get excited compared to other things in the world. The most interesting one, obviously, is that we're having real rates at a high. We're having higher risk-free rates, but spreads are also becoming interesting, and in particular in some niches in the market. But before we talk about what we want to buy or what we want to sell, I'll pass to my colleague Tao Pan, who heads research, and she's going to talk about what we see within the credit market and how we see the default cycle evolving in the coming 12 months.
Yeah, thank you, Alberto. And as we show in our presentation, in our process, we use models to help us understand our macro view and form our sector views, and essentially how we think the credit cycle is going to play out. And one key factor supporting our rates higher for longer view is that we still see inflation continuing to be stickier than what current consensus is expecting. And as we shown at the start of the slides, we think inflation will remain above central bank targets even by the end of next year in the US and also in the Eurozone. And also there is a risk of inflation re-accelerating next year, especially in the US, given the fading of disinflation in core goods, sticky wage growth, and also upside risk to oil prices given geopolitics. And against this environment, sorry, if we can go back to the previous slide. Against this environment, why do we think credit offers opportunities as an asset class? So with rates higher for longer and with the markets realizing that, we are seeing long end rates moving up and risk volatility rising. And at the same time, we also think based on our regime analysis, credit volatility is also going to rise. And this will help us create more attractive opportunities for entry. And this is basically what we are showing on this slide, which shows in the past credit spread across different rates move environment. And currently we are in a spot in the orange part where, as you can see, depending on central bank reaction function, we could still see some rate spread widening, but it's capped in the absence of a recession. And if we move on to the next slide, the second point is we are not seeing a very deep distress cycling forming from here. And we think default rates will start to rise a bit more in the US and Europe. However, such rises will be much more moderate compared to the peaks in the previous cycles. And this is because corporate fundamentals are still pretty healthy in the US and in the Eurozone, which is basically what we've shown here. As you can see on the left, the high yield companies in the US and Europe, they haven't relevered as they did in the past cycles. And also the global credit maturity wall is still extended into the following years. And putting this together, and this is what we show on the next slide, in our default rate model, in our base case, we think high yield default rate will start to rise to 4.1% for Eurozone and 4.4% in the US into next year. And this is up from 3% and 2.5% this moment. So there will be a rise, but as you can see here, it will be still much more benign compared to the cycles in the past. However, with the shallow default cycle, there could still be more credit dispersion and more alpha opportunities. And now I'll pass on to my colleague, Eddie, who will be elaborating more on the opportunities we see now.
Thanks, Dao. And so, if we just take a step back, think about, the last 6 months and highlight the points we've been speaking about for the last 10 minutes, which is, fiscal dominance remains. Central banks will not be cutting next year. And the bottom sort of 50% of consumers are being hurt by inverted yield curves more than, let's just say, sort of, the top 50%. So what does this mean? It means more dispersion. It means more moment of vol. It means that in credit, while there's value overall, there's the good, there's the bad, and there's the ugly. So what's the good? Now, within the good, the sectors that we've seen, to outperform in this environment, firstly has been some of the reopening sectors where we've continued to see, strong consumer spending towards holidays, leisure. Just today, we again saw, the inflation print strong, specifically on some of the more leisure-related segments. We've seen spreads tighten significantly. Just for example, RCL, Royal Caribbean stock is up almost 100% this year, off the back of some of these. Following from that, the other goods have been, catalysts like Greece, where effectively they've been a beneficiary, not just of sort of the stronger reopening, but also the diminishing political risk with the re-election of Mitsotakis. So there we've seen, spreads, Greek corporate and bank spreads, which traded much wider than the rest of Europe at the start of the year, have come in, have come in significantly from their wides. They still trade a premium, but that's sort of been another space. Other things that have been good have also been oil credits. So, and I don't mean the major oil complex like Total and Shell, but others like Ithaca, EnQuest, which trade, at 600-700 spread. These are companies with break-even oil 25. They have been, another point which has sort of been good. And then finally, sort of on the good side, we've also had things like, certain bank tier 2s, certain 81s, where we've sort of seen, some amount of stress that sort of remained sort of post, some of the Credit Suisse events, within that space. And we'll get into that in a second when we go through the trades. What's been the bad? The bad's essentially been SPV type models. So sectors which have over-levered balance sheets, thin margins, that essentially cannot fund themselves in this environment. These have been things like, in some cases, REITs, which we've sort of seen multiple entry points sort of through this year, where they've sort of, we've had sort of blowouts, if you want to call it that, from a spread perspective, as the market realizes higher for longer, and the fact that some of these capital structures aren't sustainable. Also within the bad, we've had certain retail. So think about it, one of the most crowded trades this year has been to be long USIG. But specifically when that, retail has been pretty bad. We think about, Macy's and Nordstrom and Newell Brands and a list of others, which effectively are companies with declining margins, over-levered balance sheets, and they are more exposed to the bottom 50% of consumers. Other examples of bad, though a bit more niche, have been things like the debt collectors, which basically, again, are SPV models where they buy NPLs, more exposed to the lower 50% of consumers. These NPLs, in terms of return, rate of return, are going down. However, their funding costs for these debt collectors is going up, making the full funding model basically negative free cash flow. Then when we get into the ugly, there really hasn't been, if we, aside from a few idiosyncratic blow-ups this year, if we think about, casino in here or in Europe, or we think about things like Rite Aid in the US, we really haven't seen that much of ugly. However, there are definitely points that we have within Europe and the US where we're seeing, too much froth, over leverage, and they're definitely more vulnerable as we go into next year to more sell-offs. More classically are things like the private credit strategies, but within sort of the liquid space, and we'll touch upon this in more detail next, we've got things like SoftBank, which are, when we think about it, it's a name which is effectively an SPV business model. Their assets are basically, private assets, mismarked and much higher valuations than some of the fundamentals or where secondary markets are, and the spreads still trade very tight. And with that, I'm going to hand over to Alberto for what's in the book now and the trades we have on.
Thank you. And by the way, we're also always taking questions. You can put them in the chat. We'll start Q&A in just a couple of minutes. So how do we square this new environment, with our book? We're in a higher for longer environment. We're in a rising default rate environment, but we're not in a distress cycle. There's a lot of investors that have been waiting on the sidelines for a big buy, for a COVID type, sell-off. Let's wait and buy a distressed fund. It's not happening. It's not happening because fiscal spending is still very strong and because companies have termed out maturities and reduced their debt. So in the distressed world, the apples that are falling from the tree are the worst ones, the ones that you wouldn't want to buy anyway. There's still a lot of private funds. There's still a lot of capital on the sidelines in private debt funds and private equity, which have not been marked to market. So what has value in our view is the liquid space. The liquid space has repriced. Rates have repriced, maybe not fully, and spreads have repriced, particularly in some areas where the perception of recession risk or default risk has been higher. And one of them has been the Eurozone since the start of the Ukraine conflict last year. In our strategy, what we do differently from others is we combine bottom-up research and deep dives in credit with top-down catalysts, top-down analysis. One of them is higher for longer, which shapes the broader context, but there's also more specific sector and country catalysts. And the second thing that we do is we always look for convexity, not just carry, unlike a lot of investors in credit historically. And the third is that we want to be fast. Our book is liquid. We don't have hidden sticky structures that are not sellable. And that means that we can turn around relatively quickly. So over the coming months, if we think about catalysts between 1 and 6 months, what are the things that we like the most, we dislike the most? Well, in the middle of the book, you have credits that in our view will perform in most of the environments, whether we have growth or even a shallow recession. And these are defensive names in sectors like gaming, industrials, some of the automakers. Some of them are in slightly cyclical sector, but they have defensive names, or we are in a defensive part of the cap structure. And generally, we're buying bonds with coupons between 8 and 12%. Why? Because we don't believe in a return to the pre-COVID world, and we want coupon yield, we want cash flows that amortize a potential rise in rates. And we want companies that have already issued high coupons, that can sustain those coupons, not companies that were funding at 3% and are going to fund at 8 or 9% for the first time. So these are companies and capital structures that can survive, and that's part of the core of our book. They have upside, but they have also very good current yield. What do we like the most as longs? And that's on the right side. Well, we like high yield, and we like the mezzanine part of high yield. Why? Because we're going to have a few defaults. Default rates were very low, as Tao said, 2% in high yield bond indices, 0 in high yield CDS indices in credit derivatives. And default rates are going to rise, but are not going to 10%. For a lot of reasons, including from bank lending to growth, to recession risk, to corporate balance sheets, both top down and bottom up. It's very hard to see a very fast default rate environment unless government stops spending, and spending continues because of elections and because of geopolitical risk. So in a rising but low default rate environment, do you get long massively on everything in the market? Probably not. You want to have a cushion. As a responsible investor, you want to have a cushion because defaults will rise, and there are sectors that are there's bad and ugly companies. But that mezzanine cushion, if we're able to trade it, it's something that yields between high single digits for senior mezzanine and mid-teen IRRs for junior mezzanine tranches with a cushion of 10% losses. That's extremely attractive to us, and obviously it's not a buy and hold, but it's something that we've had at different points in time since last year. We like across sectors, banks and energy. We think that there's selective banks that remain hurt by the CS event earlier in the year. We did not have exposure. Actually, we had shorts on the bank index at the time, but we were able to buy across other banks, commercial banks, with a focus on Europe. European banks are generally well capitalized, and we like going into commercial banks even in the periphery. US banks we find too tight in spreads, and we actually think that some of the alternative lenders might be at risk of holding too much duration, even some of the brokers. So US banks, we had them on the left side, but European banks generally we've been liking. Energy companies as well in some areas have upside, and they've provided pretty good appreciation. And finally, one of the ideas which is most convex to us is Ukraine, where we think that with a protracted war, which is our base case scenario, Ukraine will want to move to a level of independence outside of the aid that they are receiving, and they will want to move again to a situation where they're able to fund independently. And to do that, they have to restructure bonds, which we bought in the high teens. They're now in the mid-20s, high 20s. We believe that these bonds have the potential to double in value on a restructuring deal, where Ukraine will, of course, want to have a haircut, but from a much higher base, from a much higher par value and accrued coupons. We think this catalyst is independent. It's independent of the war ending. There's news on Reuters recently about Ukraine looking for a deal. It's dependent on the IMF. That's a stability analysis, which will come towards the end of the year and probably will kickstart negotiations. Again, the margin for error, the price at which we bought these bonds is so low that even in a hard haircut, starting from 115 par, including carry, it's an asset that we really like, that offers pretty good convexity, and it's a rare upside in this world where distress has been very sought after by distressed capital. Like looking at the shorts, shorting is something that has been very tactical this year for us. We've been making money on shorts, but we've been always trading them in an environment where central banks are potentially pivoting or mindful of volatility. What are the shorts that make most sense here? Is the companies that can sustain higher funding costs and the companies that can sustain high commodity prices, or the parts of the economy that are more vulnerable. And that's the consumer in the UK and the US. Unfortunately, the bottom 50% is more hurt by higher rates in the front end. It's companies that are SPVs, that buy assets and that have low yield liabilities, historically very levered, like Intrum or like the REITs. It's also emerging markets, which are commodity importers and have historically had, currency pegs, so they've used public and private funding to spend and to preserve stability in their currency, like Egypt, for example. In the developed world, BDPs are something, Italy is something that is potentially at risk of repricing. We've already seen a repricing in BDPs in the last few weeks. The fiscal premium with very strong supply from treasuries and from pretty much a lot of the other developed market countries, having a tight BDP spread is becoming more difficult. And we think the privatization plan from the government is not enough to offset the extra spending that they're planning to do. And finally, as a tail risk, which is not our base case, but in case of recession, we do think that the many parts of the US credit market, including triple Bs, including cyclicals, including home builders, look too tight now. And we think that generally long duration and long US investment grade have been very, very consensus trade this year. Not correct because it's essentially down, but hasn't repriced either to a massive extent. And so we think that potentially next year, these false safe havens or fake havens in the market might reprice further. So that's how we want to invest, being very tactical, combining top down and bottom up, looking at convexity, not just carry, and being very quick in reassessing our book. That's how we want to invest in an environment where there's higher for longer, where safe haven assets are no longer there, and buy and hold is no longer the right strategy, but investors has to be as active as possible. And with this, together with Hope, we'll take your questions. Please feel free to put them in the chat. As a reminder, after this call, we'll also publish and send a replay to everyone.
So I can see, to kick off, I think if I can group a couple of the questions. The first question that's come up effectively is similar to what we were talking about before, which is essentially, at this level of spreads, why not be levered long spreads 3 times, as opposed to sort of thinking about this from a long-short perspective?
Yeah, so there is, and I would say you can flip a coin and be lucky, but the lack of volatility that we had this year does not necessarily imply that there's going to be low volatility next year as well. So if I told you that we were late in the cycle, with oil above 100, we're going to hit new highs in the 10-year, what do you tell me about credit with a 500 bp spread? Is it a long or is it a short? Well, it's probably a long, but on balance, but you're going to have a lot of bumps, and it could be a short at different points in time. There could be a lot of things that break, and that's where we come in. We have had all positive months this year, including March. We want to be able to buy when other people are selling. I mean, we respect anyone who's just been long on leverage, but we are also very aware, having been through the Lehman crisis, through the COVID crisis, and for over 20 years in credit, that there can be accidents that you don't foresee. And that's why we want to be able to be tactical, not because there is an aversion to being long. We like being long. We bought $500 million in bonds during the COVID crisis, pretty much. But we want to get the right entry points. And there was a nice entry point post-summer. It was a nice entry point around Credit Suisse. And we think there'll be even more next year. But yeah, on balance, we are now slightly net positive on credit, and we're generating a good carry. We just don't like holding things when there's no more upside.
We like to trade the carry and not just be long the carry at all times. The second question, or if I can just again group a few of the questions up, there are a few questions basically on oil. Essentially, we've seen a significant amount of geopolitical volatility, especially now over the last week. How should we be thinking about the impact of oil on inflation? Are there geographies which are more exposed than others?
So the short answer is, in the developed world, oil obviously would bring headline up, and consequently would bring also core up. If we have $10 oil If we have an increase in oil of $10, for every $10, there's around 30 basis points in higher headline. And we've been modeling with Taupan and altogether this very, very carefully. So $100, $110 oil means that we're going to be definitely with a 3.5% handle in US core at the end of next year, which means pretty much stable inflation, and which means the Fed will have to do more. So it's not a great thing for rates. For high yield, where you have a good spread cushion and duration is not very high, it's okay, but you're going to have to be in the right sectors. And it's not a great thing for Europe on balance, which is an energy importer and more vulnerable to higher gas and oil prices. So higher oil means more vulnerabilities in Europe, in the periphery, and to some extent this is reflected in our shorts, which are areas of the world and government capital structures or companies that cannot really support high energy prices.
So, this leads quite nicely onto the next question, which Tao, I think you'd be in a great position to answer. So, as you've sort of been saying, higher oil hurts Europe, especially on the inflation side, more in the US, given the fact that the US also now is a net exporter of oil. Tao, one of the questions which we have is essentially given this backdrop, given what's happening, in Russia, Ukraine, as well as now in the Middle East, how does that fit in with sort of our estimate for European default rates to sort of be lower than the US? Why is European default rates, or why are we expecting them to sort of be lower than the US in sort of this environment?
Yeah, thanks, Eddie. And to answer the question, yes, indeed, the European is more affected by like you are saying, the geopolitical risk and also oil prices. But at the same time, if you look at the high yield universe as a whole for the Eurozone versus the US, you can see the fundamentals for Eurozone high yield is not that bad. And also in terms of the sector split, it is actually better than the US. That's why in terms of the increase in default rate, it's actually comparable to the US. However, even in our projections, we already factor in a little bit of that impact in terms of our default projection at the start of the year, when Eurozone growth is not as sort of negative as what we are seeing now. We are actually expecting even lower default rates, and now that has already moved up to be more comparable to the US. And then at the same time, there are also more technical or legal factors that we should take into account, which include either bankruptcy laws in the US, which, as you can see, historically, even for the same sort of macro environment, so for the same sort of growth rate, the default rates actually in the US are actually higher at the peak compared to the Eurozone. So I would say the sector mix, the fundamentals as a whole for the universe, and also the specific legal reasons contributed to our default rate forecast.
Perfect. Thanks, Tao. We have a few more questions, but I'm just mindful of the fact that we're coming up to 45 minutes of the hour. We'll get back on each question individually. We can see who sent them. Alberto, over to you.
No, thank you everyone for your time. We'll follow up over the coming weeks with something that will be in more detail on our outlook for the end of the year and next year with our next silver bullet. And you'll also see our replay for this call. But thank you so much for your time, and please reach out to us individually with any additional questions on our book. Thank you.